Hello, amazing traders, and welcome to this module on indicators. Okay, so we're done with price patterns, we're done with candlestick patterns. We've learned about the trend law, we've learned about resistance levels, support levels, and so on and so forth. We've learned a lot on technical analysis. Okay, and in this lecture, we're actually going to look at indicators. Okay, so indicators are tools used by forex traders in technical analysis which help traders forecast and confirm price changes and direction in the market. So these are tools. Okay, these are tools basically used by traders, by a lot of traders all around the globe to trade. Okay, they are trading tools. So indicators are computer programs developed with mathematical calculations to act based on price action, based on volume, based on momentum, and other important metrics. So these are programs created by programmers, okay, for forex trading, of course. So they act based on certain metrics in the market, like price action, like volume, like momentum, and so on and so forth. And then indicators have two main functions. So indicators have two main functions: to confirm, okay, and then to predict. So we can use them as confirmations. Okay, we can also use indicators as confirmations in addition to things like price action, to things like candlestick patterns, to things like price patterns, and so on and so forth. So indicators can be used to confirm our buyers and also to predict the movement of the market. So there's one other thing you need to know about indicators, which is indicators are lagging systems. So what do I mean by lagging systems? Are systems that are slow in action. So they are not as fast as price action, but indicators give you simple rules: where to enter, where to come out. You enter when this indicator does this, and then get out when this indicator does that. That's how indicators work. Okay, but they are lagging systems. They are lagging systems. It means they give you signals after the moves happen. Okay, so you might not get the signals early. So that's just the downside to indicators. There are four types of indicators, which are trend indicators. We have volume indicators, we have volatility indicators, and we have momentum indicators, which are also known as oscillators. Now we're going to look at each and every one of these singularly. Okay, starting with the trend indicators. So now the trend indicators. So what's a trend indicator? What do they do? Okay, so trend indicators help traders identify the strength and direction of the trend on the time frame they are placed on. That's they are used. That's basically they are used. They help identify the direction of the trend, okay, the direction and the strength of the trend, okay, based on the time frame they are placed on. So that's what trend indicators do. The examples of trend indicators include moving averages. We have the moving average, we have the MACD, which is moving average convergence divergence. We have the parabolic SAR, we have the ADMI, which is the average directional movement. All of these are indicators, and they help traders identify the direction and strength of the trend. Identifying the trend could be a pin in the S, could be tricky sometimes because the market tends to be tricky sometimes. So many traders that do not want to do the hard work just place some of these indicators with different settings on their charts, and then they tend to get a clearer picture of what's happening in the market. Okay, so that's about the trend indicators and what they do. Now we have the volume indicators. These categories of indicators are used to determine if the volume behind a particular movement is high or low. So they basically determine the volume. So high volume typically shows that the pair is being actively traded. High volume typically shows that the pair or the asset is being actively traded. And then they are used by a lot of traders in spotting reversals. So major reversals in a trend usually carry high volumes. Major reversals in the trend usually carry high volume. If you remember our video on volume, okay, when we were learning about the MT4 platform and the TradingView platform, we looked at volume. So If you check the volume very well, or if you study volume well, you tend to see that major reversals tend to carry high volume, okay, because the big boys are now in the market and there is a lot of money in the market. So they change the move, they change the direction, so there is in turn an increase in volume. So some examples of volume indicators are listed below. We have the money flow index, we have the Chaikin money flow, we have the rates of change, which is the ROC indicator, we have the ease of movement, and we have the unbalanced volume. These are all types of volume indicators. Okay. Now we have the volatility indicators, and these categories of indicators are used to determine the volatility in the market. Volatility in the market. And what's volatility, right? Now, volatility is the rate at which the prices of a currency pair or asset changes. The rate at which the prices of a currency pair changes. Now, if I go to this chart, okay, if I go to my MT4, you are going to see that the price changes. Okay, now look at from 0.99. If you just observe, you tend to see that the prices here change. Okay, the prices here change. You can see it. Now, volatility is basically the rate at which the prices change. So when the prices change very fast, it means there is high volatility in the market. And when the prices change very, very slowly, it means there is low volatility in the market. There's low volatility in the market. Okay, that's one thing you have to know about volatility indicators. Now, as you can see, there's an increase in volatility. There's a bit of increase because the prices, volatility actually goes up and goes down. Okay, so some examples of volatility indicators include Bollinger Bands, average true range, ATR, and envelopes. We are going to look at a lot of these indicators. Okay, we're going to look at a lot of these indicators. Okay, so these indicators, these types of indicators, volatility indicators tend to show you how much volatile the market is. Now we have the last types of indicators, which is the momentum indicators. Okay, now they are also known as oscillators. So these indicators help traders tell traders about the momentum change in the market. They calculate the momentum of the move and then plot it on a graph of 0 to 100, 0 showing that the pair or asset is oversold and 100 means it's overbought. So if something is oversold, it means there are higher chances that it's going to reverse and start buying. And if something is overbought, there are higher chances that it's going to reverse and start selling. Okay, so it can serve as a confirmation. So that's just the idea of overbought and oversold levels. Now, momentum indicators help traders find reversal points in the market and also help confirm the strength or momentum of a move. Okay, so they also confirm the strength or momentum of a move. Some traders do not just use them to find oversold and overbought regions. They also use them to confirm the strength of a move. So let's say if the move is going upwards, or if the trend is going upwards, the momentum indicators could help you determine if this upward movement has a lot of momentum backing it. Okay, so that's one importance of the momentum indicators. And some examples of these indicators include the relative strength index, the RSI, the stochastic indicator, and then the commodity channel index, the CCI. Commodity channel index, stochastic indicator, and the relative strength index. We're going to look at least one example from each type of indicator, each category of indicator we've just looked at. We're going to at least look at one example as we study them individually. Now, we have the next slide, which talks about combining multiple indicators. So one mistake a lot of traders make when starting out is being too dependent on indicators. So most newbies are usually very dependent on indicators. They just plot their charts with indicators all over the place, and they end up getting confused. Okay, So therefore, using too many indicators on their chart and selecting indicators randomly, by doing so, they end up becoming more confused and more frustrated. So the market has the ability to frustrate you if you do not follow the rules, if you do not trade with maturity, if you do not trade properly. Okay, so newbies who tend to be too addicted to indicators tend to get frustrated even more, because the indicators, having too many indicators will not give you the perfect strategy. There is no perfect strategy. There is no perfect system, okay, in the forex market. There is no perfect system. You can only try as much as possible to minimize your losses and maximize your wins, okay, because losses are part of trading. Losses are part of trading. Adding too many indicators to your chart, to your strategy, will not just give you the perfect thing, the perfect thing you're looking for, okay? So that's something you should take note of. Now, some advice when combining and using indicators. Do not combine indicators of the same type because they give similar information, except if the strategy is very specific about combining like indicators. So one mistake I see newbies making when combining indicators is that you see them using plenty indicators. Some people will have up to 10 indicators, up to 15 indicators on one chart. You won't see shit. You won't see shit. You won't see what's happening in the market. Why would you have 10 indicators? Why would you have 15 indicators? As if your life depends on it. That's not the way to trade. That's not the way to trade. We're going to learn to trade properly during the course of this course. And it's not by using multiple indicators, okay, or being over-independent or over-dependent on indicators. So when combining indicators, use indicators from different categories that show different information. That's another advice I will give you. So do not use too many indicators. 2 to 4 is enough. So you can use 2 to 4 indicators. That's enough. Do not use too many indicators, okay? So just add, just have multiple ways of confirming. Just have multiple ways of confirming your bias. Okay, do not just cover your chart with indicators and then trade blindly. You have to look at, you have to follow the trend. You should make sure you're not trading against the trend. Okay, so this point says understand that losses are part of forex trading. So instead of trying to eliminate losses with many indicators, traders should instead use proper risk management, trade management to minimize losses and maximize wins. We are going to look at trade management in a whole module, okay, risk management and trade management as a whole module. So after you go through this, you learn how to maximize your profit and then minimize your losses. So some good indicator combinations could be trend indicators plus momentum indicator. So one trend indicator maybe plus one momentum indicator, and then volatility indicator plus momentum indicator, and then trend indicator plus volume indicator. You could also have let's say one indicator from each of the classes of indicators, or one indicator from 3 classes of indicator combined, okay, so that they give you good signals. Okay, some indicators tend to perform better in trends, some perform better in consolidation, and so on and so forth. So when you use indicators properly, you tend to get the best entry and exit points. So do not combine too many indicators as a trader. Do not just follow them blindly. So that will be it for this video. In the next, we are going to start looking at these indicators one by one, and you're going to learn a lot. And hope to see you in the next video. Bye.